Welcome back to the channel. A lot to unpack this week, talking about CPI headline inflation, that print coming in at 2.5%, lower than the previous month of June at 2.7. Ultimately, we have not seen a 2.5% inflation print since March of 2021. This is really good news for the trajectory for the Bank of Canada ahead of their next Bank of Canada rate announcement on September 4th and the subsequent ones following that in October and December. What will the Bank of Canada do next? What's the data telling us? What does this mean for homeowners, mortgage holders, those looking to go out into the market and buy? Does it actually move the needle that we're seeing these inflation numbers come down, the Bank of Canada potentially cut? We'll unpack our thoughts and opinions this week. Now, let's get right into it. Ultimately, with the Bank of Canada now seeing that inflation, the CPI inflation print coming down to 2.5%. That's ahead of their September 4th rate announcement. It does give the Bank of Canada ammunition to continuously cut maybe another 0.25%. I know there's a lot of conversation around if the Bank of Canada is going to go a little bit more aggressive, maybe 0.5%, maybe 0.75%. I mean, ultimately, I think a 0.25% is more than enough right now. Don't forget the Bank of Canada has already cut 2 times ahead of the US Fed. That is another rate announcement that's going to be coming up in September as well, one to pay close attention to. So make sure you're subscribed to the channel if you want to stay up to date with what's happening in the US and the Canadian central banks when it comes to those policy rate decisions, because they are very important to the direction of where the Canadian economy will be headed, ultimately when it comes to fixed rates, and where the Bank of Canada could be moving in the next few meetings. So ultimately, with all this information, we definitely saw core, medium, and trim, the more important numbers to the Bank of Canada, right? Headline inflation is great. Core, medium, and trim inflation numbers are the preferred measures for the Bank of Canada, and those have pulled back significantly as well. So we're seeing this trajectory, ultimately the data aligning with what the Bank of Canada's broader expectations of inflation are. We're going to see that get down to 2%. Now, we're not out of the woods just yet when it comes to inflation. We're going to see, some ebbs and flows, some bumps in the road as we get these base year effects pulling in those year-to-year changes. But ultimately, I think the story is that inflation is on its way back down to 2%. Whether you agree or disagree with the way Stats Canada reports its inflation numbers, the CPI numbers, that is, a very important conversation, one that we get a lot of comments on. But I mean, at the end of the day, this is what the Bank of Canada is using. They're looking at these numbers based on Stats Canada. And ultimately, with those lower numbers, I do believe that the Bank of Canada will at least cut 0.25% in September. I think it's almost baked into the cake. I mean, we could be wrong, but ultimately, I think with the US cutting for the first time potentially in September, we're going to bridge that gap between the Fed's fund rate and the Bank of Canada policy rate. We're now sitting with the Bank of Canada policy rate at 4.5%. So let's see if that comes down a little bit more. Now, ultimately, there were some major pull factors and push factors on why inflation sort of pulled back. I mean, we're seeing travel-related expenses pull back. I mean, ultimately, gas prices are still a continuing problem. Remembering that some of these numbers, these core numbers, are stripping away things that are volatile like food and energy, which incidentally are what Canadians need every single day. We need energy, we need food, but ultimately, shelter costs still very elevated. But we're seeing some pullback as potentially mortgage interest costs are starting to turn over slightly. Not major, but starting to turn over as those interest rates begin to come down, as we anticipate them to potentially be coming down further in the next 6 to 12 months. That could help reduce shelter costs. And I believe it was at, I think we're at 5.7% for the previous month. Shelter price were only about 5.7, and that's down from 6.2% in the month of June. So small monumental moves. But that basically means that Canadians, as they're renewing their mortgages, are going to potentially be renewing into hopefully lower and lower rates as we start to see this mortgage renewal cliff come into focus. Now, that's not to say that it's an over dramatization. There's still a lot of issues with Canadians, not major ones with those fixed rate mortgages, but more with those Canadians that are in adjustable rate fixed payment variables. These are the ones that I think the Bank of Canada is paying very close attention to, as those are the ones where the payments remain the same no matter what happened to the Bank of Canada, which meant that more of that payment, if not all of that payment, went towards covering the interest cost. So your entire mortgage payment for many Canadians was literally just covering the interest cost, and in most cases, not even enough to cover it, meaning that their mortgage balances increased, which means their amortizations jumped up. And when these mortgages go to reset, that could be a major problem if interest rates don't continue to pull back. We could see some major headwinds as the banks continue to prepare for these mortgages by putting away more and more, millions and millions of dollars in provisions for credit losses. Ultimately, how this story plays out as we see, some signals that more and more Canadians are finding it challenging, whether they're listing their properties, in a very difficult market, or they're basically experiencing hardships and defaulting on their mortgages as those default rates continue to tick up. I mean, are we going to see those actual default rates surpass the 2008 Great Financial Crisis here in Canada? I mean, that's ultimately the question. I think it's a big number. I mean, 1% is still very, very small when you think about what happened in the US, where those numbers were pretty much double digits. But here in Canada, I mean, if we see those numbers increase, is it going to surpass the 2008 global financial crisis, or is it going to pull back? I think at the end of the day, the story, if it continues on this trajectory, and we're not saying that it is, but if we continue to see the inflation print come in down, right? If we start to see unemployment stayed at 6.4%, I mean, ultimately, we're starting to see some pressures in the labor market. Who's employed? That labor force participation is pretty much in that middle group. I mean, the younger Canadians and the older Canadians are definitely finding it more challenging to gain entryway or find a job. So as we continue to see manufacturing jobs being pulled back, factory positions, those in the construction industry, development and building, I mean, all these potential jobs to build all these homes that were required, as we see these developers pull back, I mean, how is that going to impact that unemployment number? And obviously, what's going to happen in the future moving forward? And once again, just to sort of tie all this into, inflation coming back down to 2%, we have to keep in mind that when the Bank of Canada began its rate hiking cycle back in March of 2022, each time the Bank of Canada went to go move the needle onwards and upwards, it can take anywhere from 12 to 18 months for those particular changes to actually be felt in the economy. That's what we call the lag, right? We've talked about on the channel. Now, if we see that it's taken this long to get the economy to that pretty much breaking point, maybe that recessionary point, every Canadian's feeling these pressures, what is it going to mean on the flip side? As the Bank of Canada begins to pull back on these policy rates, how long will it take for these policy rate decisions to bleed into the economy? It doesn't just happen overnight. Bank of Canada cuts, it doesn't instantaneously change the sentiment. I mean, we can see it in the housing market. Many people thought, hey, the minute that the Bank of Canada starts cutting, we've cut twice, there's a third one on the way. We'll see how the data rolls out in the listings of homes, the sale home prices, as we continue to monitor that situation. But ultimately, I don't think it's going to move the needle. I think a lot of Canadians are still apprehensive about buying a home in a recessionary market where their job security is on the line. They're not sure if home prices are going to correct a little bit more or if we've hit bottom or not. I mean, this is literally the reality. A lot of people try to time it. That is up to them. But ultimately, you have to look at the market, you have to look at the sentiment. And we're not in a very positive sentiment market right now where developers want to build, builders want to build, construction is booming. We're not in a booming economy. And as we take time, as these interest rate cuts take time to get those policy rates from their higher bound down into maybe a neutral zone, we don't know where that's going to be. Maybe it's 4%, maybe it's 4.25%. We don't know. I mean, the Bank of Canada could be cutting another 3 times in the next little while, and see if we get that policy rate back down to 4% or below. I mean, that is literally the question. What's going to happen in the next little while? And is that going to move businesses to start investing in productive measures? I mean, that's literally the conversation. I think the bigger picture is the unemployment, the economy. Canadian businesses are not really eager to spend. Most Canadian businesses are not, risk takers as opposed to the US. Very heavy, very strong entrepreneurial spirit. Here in Canada, I mean, not to say every business in Canada is not like that, but the general consensus is they're rather hire maybe foreign workers, temporary workers, short-term workers to, increase production, but it doesn't necessarily mean that they're increasing productivity, right? You're paying more or paying less, but you're not really making the means of production more efficient. So a company that invests $10 is not investing that $10 to make back 9, right? So what's happening is they're not investing in the manufacturing, they're not investing in the tech, they're not investing in the software, the machines that they need to help make these jobs more efficient, to produce more, right? To produce more Canadian product. We need Canadian businesses to really flourish here in Canada, especially as we have a Liberal government right now under Trudeau increasing the capital gains requirements to 66%, basically cutting a lot of incentives for businesses to want to start up, as we see a major shift from private sector jobs into government jobs. I mean, like, this is a big problem. I mean, but literally, I think the backdrop, the Canadian macro, the picture here in Canada, to sum it all up, I guess to bring it full circle, it's not really in a good spot. Whether we're in a recession or not, I believe we are. The reality is if we do enter a massive recession, if we see something move the needle where we continue to see this no performance in the Canadian economy, we continue to see this lackluster growth, well, the Bank of Canada is going to have to make a move. And the reality is if we enter into a major recession, if the writing's on the wall, things get really, really bad here, the Bank of Canada is going to have very little options but to hammer down and cut those rates harder and faster to try to resuscitate the Canadian economy. And once again, that's going to have an unintended consequence, especially when it comes to other segments like housing. And that's literally a lot of questions, a lot of people's minds is on housing, mortgages, and that related topic. But I really think the Canadian economy needs some help. And I think the Bank of Canada is being a lot more proactive right now than reactive. Remember, most central banks, they tend to be reactive. They cut when a recession is, on the table, the writing's on the wall. And by that point, it takes a lot longer for them to rebound out of that, unless they're dropping rates significantly. Here, I think we're trying to play the slow and steady game. Bank of Canada obviously cutting way ahead of the U.S. Maybe a silver lining. We'll see how that plays out in the next few months, if that actually moved the needle. And what's going to happen with the U.S. cut in September? Is it going to move fixed rate mortgages? The election that's coming up in the next little while, ultimately we'll want to keep that in mind. Who enters the White House is very important when it comes to fiscal and monetary policy, or how they're going to be spending. Are they going to be running a deficit? Are they going to be, pro-business? Maybe not pro-business. I mean, these are really the questions on how it's going to impact the economy. And I think that's really something to pay close attention to. Do you think it's something that we should be paying close attention to? Let us know in the comment sections below. But wishing everyone a wonderful weekend. We'll see you all next week. Thanks again for stopping by.